Welcome to another episode of the Unicorns podcast. I'm your host, Justin Kelly. Today on the show, we're focusing on the rise of private credit in Australia and the growing funding gap facing the country's lower mid-market businesses. I interview Mark Wang, founder and managing director of Colter Bay Capital, and Sean Garman, the firm's chairman. Colter Bay Capital has just launched with a clear mission to provide flexible growth capital to profitable Australian businesses that are often overlooked by traditional banks. While many of these companies have strong cash flows and experienced management teams, they frequently struggle to access funding because lenders remain focused on collateral and balance sheets rather than business performance. In this conversation, Mark and Sean unpack why Australia's private credit market is still in its early stages, why they believe a significant structural funding gap exists, and how Colter Bay is positioning itself to support the next generation of ambitious Australian companies while delivering institutional-grade returns for investors. We also talk about Mark's career in private capital markets, Sean's global experience across New York, London, and Hong Kong, and why both believe the next decade could see private credit become one of the most important forces shaping how Australian businesses fund their growth. Mark and Sean, welcome to the program.
Thank you very much.
Hi, Justin.
Okay, Mark, I want to start with you. You spent 25 years inside major institutions like Commonwealth Bank and Merrill Lynch. What did you see during that time that made you think the Australian lending system wasn't really working for a huge number of businesses?
Well, it really started because I spent my career in the U.S. and New York on Wall Street, and creativity and, sometimes to a good thing and to a bad thing, it's always to an excess. So you find the final point of where capital meets, issuer and investor. Coming to Australia, I think there's a sense, and I've been here since 2017, is a sense that there's a level of conservatism that overlays the entire economy, and it overlays lending. And conservatism can be a very, very good thing, but to an extent that it stifles actually lower middle market corporate growth, it's not a great thing. And that's why I think that evidencing the gap is really the key to the key to what I see in terms of a financing gap.
And Sean, to you, you've spent most of your career overseas, from New York, London, Hong Kong. From that international vantage point, how underdeveloped does the Australian private credit market look to you?
At least 10 to 15 years behind North America and in Europe. And that's the shocking thing from my perspective, that Australia sometimes can be so ahead of the curve in so many different areas. This is a wealthy, developed country. Yet private credit is 10 to 15 years behind what you would see in Europe, what you would see in America. It does so many negative things for the country, for the economy. It stifles innovation, amongst other things. So that's one reason why when we're looking to invest in private credit, our focus became on Australia.
But why is Australia so far behind?
That's a great question. I think there are several factors. But first, let's talk about the elephant in the room, which is real estate and the property market. That creates a very constrained cultural view towards private credit, towards investing, just thinking in general. In other countries and other jurisdictions, when you've got someone from institutional all the way down through to someone's self-managed super fund, there'll be a broader series of sectors or companies that they will look to invest in. In Australia, because it's so heavily dominated by real estate and property, it bastardizes and twists and deforms how people think about investing. The first stage is, I want to buy a property to live in. Second stage is, well, I'll go and buy a property to lease out, to rent out, and I'll try and claim negative gearing on that. And that, scales to the institutional investors. So when you kind of break down the market on a sector-by-sector basis, it's bizarrely overdeveloped in one area, which is real estate. And then it just doesn't exist for many others. And you'll know this, Justin, there's only so much amount of talent in the market. If they're all directed towards one part of it and ignore the other part, then that starts falling behind.
Mark, you talk about a $25 billion funding gap across roughly 26,000 lower mid-market businesses. What kind of companies are we actually talking about here?
We're talking about real economy businesses that fund all the major real infrastructure that you see every day around you, from the core renewables to core highways, core infrastructure, airports. Australia is unique in the sense that, unlike the U.S., they've privatized almost all the majority of their large infrastructure. And so therefore, when you get to privatization, it's all about actually economic return to the shareholder. And as a result, all services along that chain get super efficient. So Australia, like Sean says, has a world-class infrastructure, and there's effectively a world-class underlying small business, middle market business economy that's supporting all that core infrastructure beyond property, but it's just, effectively in a first world nation.
And are they ignored, or are they locked out? Are they forgotten about?
They're effectively, I don't want to use the word victim, but they're constrained by, two major issues. The first one is the regulatory capital system within Australia, which highly incentivizes the banks, and the banks are the largest proponent of lenders to small business in Australia. They are incentivized to lend on a secured basis. And so effectively, they're always looking for tangible property, personal guarantees to support the financing. And it's sort of the oxymoronic, like, given how well the property market has done from a valuation perspective, it makes the bar even higher, if that makes sense, actually, for a high quality business, which is a high cash flow generating business, but may have low tangible property. So I think that's the number one, that's one of the constraints. And the second one, which is what Sean covered, is simply just property-centric culture. And again, it's the concept of really focusing on your downside protection versus actually focusing on the underwritability of a business from a cash flow perspective. And our focus is, first and foremost, can we underwrite the cash flow, the revenue, the operating expense of the business itself? Secondarily, look at the underlying collateral.
Sean, if we look at the United States, private credit now represents roughly 7% of total credit, while in APAC that sits at around 0.2%. That's an extraordinary difference. What does that gap tell you about where Australia is headed?
Well, I think Australia will inevitably follow the United States. So what does that mean in practice? That means non-bank lenders like ourselves will increasingly finance the gap. But I think we have to take a step back and ask some more kind of foundational questions from that, which is, what is the cost to Australia as a country, as a society, as an economy? What is the cost to individual businesses and business leaders by having such a significant funding gap? And Mark has just mentioned it, but I think it's incredibly important to highlight this fact for your listeners. If you go around the world and you say to business leaders, what is the best kind of business? They would say capital light, cash flow heavy. How you make your money will be through your intellectual property, your brains, your hard work, your people. What is the one sector in the Australian economy that gets actively penalized? It is that type of business, the capital light, cash flow heavy business. For me, it just says it's something very weird that someone has to take a personal lien over their house and they're a successful businessman. That's just a bizarre way of lending. It's a bizarre way of thinking. And ultimately, by having such a small penetration at only 0.2% compared to America at 7%, it means highly innovative, highly productive companies don't get the financing they need. And ultimately, if we aggregate that up to the country, is there any wonder that we have a productivity problem in Australia? If everyone's saying if banks are saying to companies, in order to get good financing, you should really have real estate. And anyone can read economic history and they'll say very consistently, when you have a real estate-oriented lending culture, that causes a lot of long-term problems down the line, one of which is it starves businesses of capital. You should not be starved of that.
Well, just to follow up on that, and a question for both of you, why are so many businesses still being asked to mortgage their homes just to access growth capital?
Well, it's capital rules. It's the nature of commercial lending in Australia is that the capital rules reward security and they penalize cash flow heavy asset light businesses. That's really the penalty box that businesses are constrained by. And again, the business banks provide credit, but is it the amount of credit that a company actually does need to actually fulfill its actually growth aspirations or event-driven, transaction-driven? That changes the game for them. From an outlook perspective or growth perspective. And again, it's a natural evolution. I think the gap has been filled, I would say, in property private credit, and we think the next leg is really into corporate private credit, which is our focus.
But is anyone agitating from the sidelines for active change, apart from your business, which you've set up? Have there been prominent voices screaming from the rooftop about the inequity of all of this and seeking active change?
I would say it's always opportunity cost loss, but there's any number of editorials that present themselves either in the AFR or otherwise, but a recent article that I would point people to look at is an October opinion piece by Guy Debelle, former Reserve Bank governor. And he laid out very eloquently in an opinion piece that private credit is a good thing for Australia. It just so happens that well over 50% plus is all dedicated toward property. And the question is, do we really need more property lenders? And then the final conclusion is really the core engine of creativity and productivity growth, which I think is probably the big focus, is productivity growth of the economy, is feeding private credit to small, medium-sized businesses. And that's Guy Debelle's thesis. And I completely align with that. I mean, the whole thesis of Colter Bay is completely aligned with that editorial piece. So he's one, I think, of many that sort of behind the scenes recognize the overexposure and dependence upon property as the measure for fundability.
Sean, I want to come to you. Private credit has exploded globally over the last decade. In your view, what were the key structural forces that drove that growth in the United States and Europe?
Well, Mark alluded to this before, but during the global financial crisis from 2007 to 2009, banks pulled back significantly in their credit availability for companies, and at the same time, new regulations kicked in. And so as a consequence, there was a gap in the market to be filled. And it's no surprise that people in the financial services industry will love to fill a gap in order to take fees out of it. And so they did, and they were very successful at it. There was a lack of funding available for companies, and so new private credit funds came in and took that opportunity up. To a certain extent in Australia, by way of comparison to your previous question, why is there such an underpenetration? There was, to a certain extent, that type of environment. But again, as everyone knows, it's been focused on real estate and not towards the real economy.
Mark, Australia is estimated to be about 10 to 15 years behind the US. We've spoken about that in terms of the development of private credit. Does that actually make this a perfect moment in time to launch a fund like Colter Bay Capital?
I think so. I mean, it is the topic on everybody's lips in terms of wealth advisors to investors in terms of globally private credit, and not all the news is good, right? It's quite mixed.
That's true.
But in anything, we think about things in terms of their end state, and the end state is if we're 10 to 15 years behind, well, that means that at some point we will get to where other parts of the global economy will be 10 to 15 years forward. And we should be, and I've heard this statistic before, and, I'm sure I'm going to get some commercial bankers calling me that tell me that again, we're probably overusing the word capital, but from a profitability perspective for the average business banker, getting the $1 deposit from a small business is 4 times as profitable as lending that $1. So they want to provide the full service But if they were to be really pure entrepreneurial capitalists, their ranking of priority is get the cash deposit. The lending is actually just an accommodation to actually win the business. So what that tells me also is the economic incentive is not there, if that makes sense, for the banker to extend themselves from a credit perspective on behalf of the client. And our goal is to obviously fill that gap where there's always going to be potential mismatch between an issuer or borrower requirement versus actually what the bank is comfortable with. But again, like the economic disincentive is already there in terms of actually assumption of greater credit risk. But we do also understand, look, the big four or big five are the bedrock of the financial system in Australia, and by definition, they have a fiduciary duty to their retail depositors, right, to not overdo risk, and so that's the
I sort
perspective.
of piggyback on what Mark said, because sometimes I think people kind of misunderstand. They think about banks, well, you should be lending money, but banks and bankers have their own internal incentive, and that is, well, how do we as a financial institution make as much money as possible? And as Mark said, a deposit has a 4x impact on their bottom line than lending money out. So their incentive is not for a business to get the appropriate financing it needs to be even more successful. Their incentive is give me a deposit, and then I'll give you something in return. And so that does, warp and twist the incentive structure. And I think sometimes people kind of forget that. We do operate under the false assumption that we're all capitalists and all that, but the bigger the institution, the more it becomes a glorified bureaucracy. And that's the kind of bureaucratic bankers that have been constricting kind of access to capital to businesses, because internally they're incentivized very differently to how a business would expect their banker to be incentivized.
So from an institutional investor perspective, and Sean, I'll ask this of you, what makes private credit attractive right now compared to traditional fixed income markets?
That's a great question, and I don't want to go down the rabbit hole of being too technical for your listeners, because I know that some of them have got very varied backgrounds. But high level, the issue with fixed income compared to credit is that when you have a very volatile interest rate environment and you go and get a bond and interest rates go up, but the value of that bond declines in the market. I don't want to go down the mechanics of how that pricing works. But for institutional investors, they see that it's an interest rate sensitivity and it's a risk. By going down the private credit route, where you have floating rate notes to the end borrower, you've hedged, you've taken out that risk. If interest rates go up, the value of your portfolio won't go down. And this is just from talking to institutional investors, when they see the volatility that we're experiencing, particularly since COVID, if you think about it, leading from just pre-COVID to COVID, the significant declines in interest rates. Then immediately afterwards, the significant increase in interest rates. And even today, we're having to, in Australia, increase rates. It creates another layer of risk that they want to reduce. And so therefore, it's natural to move from a highly competitive but interest rate sensitive product to a less competitive and less sensitive product.
Mark, you are saying that you are targeting profitable, cash-generative, asset-light businesses. What does that actually look like in practice?
I mean, the vast majority of, you would say, the Australian small business community is actually service-based. It's a service-based economy. So when I think about businesses that appeal to us, you could categorize them probably in 6 segments, but if you focus on the services oriented, and by definition, services is generally not asset heavy, essential services. I mean, the amount of press and PR that electricians, but level 1, level 2, level 3, plumbing, HVAC, like these are core, like
you need them.
You need them, but you need them not only at the residential level, but at scale. Like that to me is core essential service where it's being provided by small business providers, but it's being funded by very, very large capital, whether it's coming from government or large institution. But outside of institutional services, you can also just look at business services. And, one of the great strengths, or maybe one of the great things that's lacking in Australia, is actually human capital, right? I mean, there's always a deficiency, and that's why immigration rates are, maybe slightly contentious in terms of how many people are coming in.
Very,
very contentious.
Very.
But just the the pure, like what I would call velocity and staffing of people is like super important. So, and those businesses which are dictating human capital movement, that's also a form of a service business, right? And so I think and then it goes into allied services, which is sort of related to healthcare, aged care, and then you go into, I don't know, you could go to any plethora of sort of services, but then beyond that, in terms of asset-light businesses, you get into businesses that are, you would call them potential middlemen, but they find a real role in the market, which is effectively distribution businesses that sort of sit in between, holding inventory between global suppliers and end users. So there's a whole supply chain on agriculture and in industry, and if you look at the macro view, the whole Trumpian-led nationalization of economies. I mean, it's going to be pretty clear that Australia and every country globally will fortify their native capability for certain products and services.
If we stay with that macro view, Sean, are Australian founder-led businesses fundamentally different from the companies you've had experience with in an international context?
No, I think that founder-led companies, whether they're in Sydney or they're in Europe or North America, they're fundamentally the same, right? It's a reflection of the individual who founded the business. I think that what we're seeing is a generational shift where founder-led businesses are now being sold to other professional sponsors, that means private equity, to the management teams, or there's the inheritance from parent to child. And at each stage in any business life cycle, it needs different kind of financing, but it is something which is consistent. It is generational. It's happening now. And so that's one of the theses that we've kind of cottoned on, which is harder for us. Like, we are seeing increasingly a large number of founder-owned businesses that are moving away from the founder, again, private equity, to the management teams, to their children. And that needs a very different type of relationship with a very different type of investor, whether the investor is equity or the investor is a debt provider like ourselves.
Yeah, I was going to just interject. And I don't want to sound too U.S. centric and the U.S. accent, but there was a very recent McKinsey report put out, and McKinsey in terms of the great transition of small, medium business in the U.S. And the first qualifier is the SMB market is the bedrock of the U.S. It's 99% of the companies in the U.S. and employs over, I forget the number, 50, 60% of the overall population. Between now and 2035, because of the baby boomer generation and the retirement, there's going to be $6 trillion of transfer that's going to occur in the next 10 years. Now and then of that, McKinsey puts their little consulting hat on and says, well, 6 trillion sounds like a lot. It's going to be, maybe 1 trillion of value. Now, the real question is actually who's going to inherit, who's going to buy, who's going to transition to that business. Is it just going to die, or will it continue? Because it's actually fundamental to the local economy. I would say if you look at the population pyramid or demographic of Australia, it is almost identical to the U.S. in terms of the baby boomer population, maybe slightly younger due to immigration, but that population set between over 55, 65, and older in terms of the retirement and the economic transition, it's real. And I think that is the thematic that Colter Bay sort of will be part of. It'll be that ownership transition for small, medium business and to affect that transaction to the next generation. And I think it's pretty critical. And I think, more and more of your listeners, and they're all touched by it and they'll identify with it at the end of the day. It's a real transition, and they just need to do a study down here. It'll show the same thing.
The question is the next generation ready?
I would say they're probably more than ready, because if you think about, we're going to provide the liquidity, but the question is always, well, do I have the desire to do it? You got to have that. That's inherently tick. And then second is like the expertise or capability. And I would say the one silver lining of AI, which is coming for every white collar job in Australia, is actually that capability like you've got an inbuilt expert that actually can guide you. So beyond just the historical benefit of having accounting software and HR software and software advances, it's now actually like an expert guiding you. So actually, I think, my thesis is this transition actually will be actually quite interesting, that they will still need liquidity, but they may actually, that entrepreneur may be more willing to do it on its own because they have that, they feel like they have that intellectual back support through whatever AI agent is provided.
A question to both of you. When you're assessing a company for financing, what are the key signals that tell you that this is a business worth backing?
I'll let Mark take that.
The most important thing that we assess is, can we look at the financial statements and can we understand how the company makes money, and are they making money from a profitability perspective? And if it's not abundantly clear that we can't define how the revenue is generated, and then like how well the profit comes off the business, then it's very difficult for us to make an assessment, because by definition, small businesses should be easy to understand, not hard.
Yes.
And if we can pass that initial screen that business on its face is a well-run business, then it does this go straight to management and industry. And what we've outlined on our website is philosophically is we will have to look at every component of the chain of quote unquote custody that impacts the company and ask the question, what could go wrong, right? And there's always a classic question of a smaller company at greater mercy, right? At a greater variability to an input shock, et cetera. So I think that the key is for us is, can we understand the business and understand where it's making its money, understand management intent, and then third is ask yourself the question along every input competitive chain, what could go wrong? And if we can make those assessments, that's how we're going to underwrite credit.
A follow-up question to that: private credit is often misunderstood by investors. So what does that institutional grade risk management actually look like inside a fund like Colter Bay?
I've spent my whole career doing it, so that's a sort of a positive. And this goes back to your question with Sean about public versus private. And, public always provides the concept of liquidity. And that's the reason why people do public bonds, is because they're liquid and they're tradable, or they're designed to be. Private credit at its core, and again, it can be, I don't know what the right word is. It can be twisted, but at its core is actually a set of guardrails, which we call financial covenants. And those guardrails are just simply designed to protect us from illiquidity, because we can't sell.
Of course.
But it's designed to give us early warning in terms of actually performance of the company and how well it's doing. And if in fact the company is underperforming what they've told us, right, those covenants are designed to be guardrails to allow us to step in and to help remedy the situation. And no one wants to go to insolvency, but ultimately really what we want to do is we want to work with the issuer to resolve any kind of like short-term issues. But I think the one key, I wouldn't say misunderstood, but it's about the private credit. It's about protecting yourself with those guardrails for issuers.
Yeah, I just want to jump on that, because obviously there's been a lot of market chatter about private credit, particularly in North America. And one of the things which has kind of hit home for me is that a lot of private credit shops, it's about a quality of people that they hire. So Mark has obviously gone through, what are we looking at when it comes to the quality of a borrower? But it's also, as a business, who do you hire? Because in private credit, to use a cricketing analogy, we're going for ones and the occasional two. If you ever see a private credit shop try and go for fours or sixes, they're not long for the spelt. And too often, private credit shops hire people who act like they should go for 4 and 6s. That's not what we're about. For investors, for ourselves, it's all about protecting the downside risk and receiving yield for it. This is a defensive investment product, And too often with people that are involved in the industry, they get ahead of themselves. They're looking to fee harvest, which is not good for anybody, particularly not the investor. They ignore or they make excuses for poorer quality credits because they want to put the money out there, which again is not good for the investor, nor it is good for the borrower. So one of the things which kind of has hit home observing the behavior of some private credit shops is they kind of forget what industry they're in. I don't want to be crude, but they do. And so for us, it's all about the defensive element of the business. As Mark said, I did for a period of time the stress debt restructuring. And when a business lives or dies, it's usually by some pretty fundamental things. If you have a business that's entirely reliant on one supplier and that supplier goes bankrupt, you're bankrupt. So to have that really understanding that real basic level, how does the business work? What are the risks around that? And is it a defensible enough business that if you provide them with credit, they're going to repay you plus interest?
And I mean, the only one comment I'd leave you with is it by definition, we will be charging a higher rate than our commercial bank peers. We will be generating a higher return, which is the messages for issuers is number one, if they're artificially constrained by lack of property or tangible property to be able to get the credit needed. But also, look, we're I've been in the capital markets investment business, and if we're not constrained by capital, we'll be constrained by common sense, but we'll also be somewhat creative, right, and flexible, and deliver a solution, right? I mean, that's always. I mean, what does a business owner want to hear? They want to hear you've got a solution that actually is satisfactory to them that otherwise isn't met, and like that's our goal. And so I don't want to again, we're preservation of capital, but at the same time, we're quite cognizant of being sufficiently creative with the borrower or the issuer to deliver the solution that makes sense to them. And like everything always has to make sense, and again, it's like for us, the key is, I think that cricket analogy is we are 100% about ones and twos. We are 100% about singles and doubles. And this is not a home run strategy.
So you officially launched the business this week. It's very exciting for you both personally. I'm curious, where did the name come from? Colter Bay Capital. I genuinely do not know if there's a backstory, a side story, whether...
Air of mystery here. Maybe we shouldn't answer this. Everyone rushes to Google Colter Bay. I mean, maybe we should keep this as a bit of mysteriousness.
I'm happy to.
We're going to keep that. I'm looking at Mark. Mark, we're not going to name this one.
Okay. Sean, what was it that you are chairing the business? What was it that convinced you to come in and back the team?
That's a great question, because I think it goes really to a number of points that we've already touched on, but others as well. So firstly, I just want to make it very clear to everyone that's listening at home. My background, obviously, I spent over 15 years, actually longer than that now, realizing how old I am, doing structured finance, structured credit, private equity. Now I'm running my own capital. And so I've been presented with quite a lot of opportunities to invest in private credit in Europe and in North America, and I've been very consistent. I'm not touching it. And the reason why is because at this stage in the game, if I'm getting presented with opportunities, it's in a highly competitive, highly crowded market. So where is what's called alpha? Where is the return which is unique? It's not just something that is piggybacking on other people. I don't want to take undue risk, in other words. And so what happened, and it's a long-winded way of explaining how I got involved with Colter Bay, and effectively it's an introduction that was made to me, to Mark. I was in Sydney at the time, and I was skeptical because, again, it's private credit. But honestly, after speaking to Mark, and he was saying this is what I have as a vision for a private credit shop targeting the low and mid-market, and doing my own thorough and extensive research, I realized firstly this is the right geography. Australia. It's the right subsegment of the market, low mid-market corporate. But I've also seen how things don't work out. I've seen founder-led private equity and private credit shops that don't perform. So it's about the quality of the person who's running it, in this case, Mark. And Mark is high quality. And look, obviously I would say that because I'm backing him, but I've got a view, and I've had it in, basically, we have to be tier one from day one. That is tier one quality of personnel. Mark and the team, are very high quality because you cannot bootstrap a business by bringing in B players. You'll do no one a service. You'll do the borrowers a disservice, the issuers a disservice, the investors a disservice. No, high quality people from day one, targeting this underserved market. And in my mind, given the quality of the team that we've assembled, looking at the strategic advisors, we've got Nick Reiner on board.
Tell us about the advisory team that you've assembled.
Yeah, so what we've been trying to do, and we've been very deliberate about this, is to complement the quality of our team, we created a strategic advisory board. Currently, we've got Nick Reiner, the former Premier of New South Wales, but also the former head of QBE, Stockland, long-term champion for Australian businesses. We've got Kirk West, former Executive Managing Director, Global Principal Investors. He's also another strategic advisor. Luke Copley, an investment banker based in New York. And so what we've tried to do is create a very senior advisory board that can help myself, help Mark, help the team, but also provide the cumulative experience of multiple decades worth in Australia, overseas. Because ultimately, these guys have seen through multiple credit cycles, multiple business cycles in multiple geographies. They will know when someone like myself is getting ahead of myself or Mark. We need to have that experience for guidance, to remind us to be humble. Because, you can listen to me, I can come across as quite confident. But you have to have an element of humility. And so we find that by having a very strong advisory team around us, we're going to be better performing for our investors. We'll be providing better quality products for the borrowers. And ultimately, that's what we're in about. We're not here for an ego trip. And having that group, I think, is going to create a significant and material difference in the level of professionalism which we're providing compared to others in the market.
Colter Bay Capital is now officially open for business. A question to both of you. What are the priorities of the fund and who do you want to hear from?
The infrastructure has been built out and, we've gone live with the platform. The priorities are like twofold and, we're going to use the concept of funnels, right? And there's two funnels and, the one funnel is potential issuers, potential transactions. And so we're
deal flow.
Very, very focused on our engagement and origination activity into deal flow. And I could say now that we're already getting quite interesting flow coming in, which again is always conceptually the validation of the thesis, right? Like there's more opportunity and there's more credit demand than there is supply. So priority is the origination funnel. And then the second funnel, and this is really where we do lean upon our strategic board, but as well as ourselves, is the investment funnel, right? And it's all about, number one, education for potential wholesale investors, family office, again, we think it's overeducated, but again, we do have to make this transition from what people perceive as private credit or private debt as being purely property to corporate based, which again is kind of the reality of the Australian economy. And I think that's where we're going to very focus on the what I call the investor funnel. So those are the two. And we're designed to be the process machine in the middle to be able to demonstrate that we're actually effectively matching up issuer and investor, and being guardians on both sides of the table, but in particular, safeguarding investor capital.
Well, we wish you nothing but ferocious success.
That's great.
Remember the name, Colter Bay Capital, open for business. Mark and Sean, thank you very much for coming into the studio today, and we wish you well. Good luck.
Thank you.
Thanks, Justin.
Thank you.